And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts, presented by RIA Advisors.
And welcome to the show this morning. Lots happened over the last 24 hours. Malcom Jamal-Warner passes away, drowned in a tragic accident. Ozzy Osborne also passes away. As they say, it comes in threes. So we're waiting for the third. I was texting my wife yesterday. I think I'm it. So if I'm not here tomorrow, I'm it. So you'll know. But no, very tragic. Ozzy Osborne, of course, even young kids know who he is, but, crazy train and, long history of rock legend as it is. But 76, I believe, was his age. He was, I don't know if that's young, being 60, and Brent being 70, it's still young. Yeah. But anyway, so tragic loss there, but we'll see who number 3 is going to be. It always comes in threes for some reason. I don't know why with celebrities. It just always seems to be the case. Can we make suggestions? Brent asked, can we make suggestions for who the third should be? Actually, my wife was saying that they flew to Switzerland, and there's no verification of this, but they flew to Switzerland where they have assisted suicide, right? So I was asking if we could book a trip to Switzerland this summer. To go see Coldplay. To go see Coldplay, exactly. Okay, seriously, get to work. This morning, news driving the markets higher at the open. S&P is up about 23 points right now. NASDAQ's up a bit. News that President Trump has announced a trade deal with China. Trade deal with Japan. And on the back of that news, automakers are markedly higher this morning. We're seeing some pretty big moves in the auto sector on that kind of trade deal negotiation. So that's helpful for the markets this morning. We'll see if that carries through for the day. Texas Instruments this morning reported earnings. They disappointed on their report. Stock's going to be down about 10% today. So that may weigh on kind of some of the chip stock sector like Broadcom, Nvidia. That kind of semiconductor space. We'll see how that kind of plays through this morning. So we kind of got a mix of news out yesterday. Now, one thing about the market's been over the last couple of days is that yesterday we were lower in the morning. They kind of rallied our way back to mildly positive territory. The day before that, we were very positive and sold off almost to flat. The market's really been kind of struggling here, and that's really a sign of deteriorating momentum. We'll talk about that some more in a few minutes. But again, this market's had a very big advance. We've had a 27% advance from the lows. That's one of the largest advances that we've seen in a 3-month period throughout many years of market history. So just, there's this old saying that, kind of everybody's in the swimming pool right now in terms of the markets. And we're seeing, of course, as we talked a little bit about yesterday, meme stocks are back. And, we're back to that 2021 type mentality of just gambling in the open markets. Companies like Kohl's, Open Door, which is the real estate technology company, have seen massive surges in call option volume, et cetera. So we're seeing just this very big, aggressive positioning now in stocks that are virtually, kind of on the verge of bankruptcy. But they have a very big short position, so it's easy to squeeze these stocks higher, and that's what we're seeing. And retail investors are buying a lot of call option bets on the big surge in call options on these particular types of stocks. But it's very reminiscent of what we saw in 2021. And this is kind of the again just another hallmark of this market, which is it just doesn't seem to care. It's kind of like the old honey badger, right? The market just doesn't care. We can't use the term, but you know what I'm saying. Markets just don't care about the headline news about what's actually going on. And, we have, economic data certainly does not suggest that the economy is just roaring along. Analysts are getting very optimistic about earnings estimates. I just downloaded the latest earnings estimates from S&P. They've been ratcheted up fairly sharply just in the last 2 weeks. So again, optimism is running a bit rampant here in the markets. Again, there's nothing wrong with that because that optimism drives the market short term, but it's also kind of a cautionary, contrarian indicator to at least consider with your portfolio management. But it is interesting, if you go back to 2021, hey, I get it, the meme stocks, right? I get it. We had zero interest rates. QE was doing, Fed was doing $120 billion a month in QE. You had $1,500 checks to households, and you couldn't go anywhere and do anything. Right? I get all that. I don't get the meme stock chase now. Where's all the money coming from is the big question, right? Where's all this liquidity coming from with interest rates at all-time highs? We're just, we got the interest rates highest level since, whatever period, and the Fed's doing QT, and, you've got to pay your mortgage, you got to pay your rent, you got to pay your student loan. It's almost the inverse environment of what we saw, but yet we see this very same speculative attitude by investors in the market today. I find it very fascinating, and kind of the topic Danny and I will talk about today is that the markets are going up, and nobody really knows why. So we'll talk about that this morning, but let's talk about the market and where we finished up yesterday. Here's what you need to know before the bell this morning. Again, like I said, last few days, markets, particularly yesterday in particular, we kind of opened lower early in the morning and then rallied back in the afternoon a bit. Day before that, we opened higher and sold off into the close. So we're not really making any real progress. In fact, over the last couple of days, we've just kind of been flat right here at about 62.80 on the S&P. Still fairly deviated above long-term moving averages, but again, discussed yesterday morning a bit about this very long streak above the 20-day moving average, which is for the NASDAQ in particular is the longest since 1999. Now, again, that doesn't mean that you're going to crash. It just means it's been a very long streak above the 20-day moving average. That typically doesn't happen very often. In fact, if we just take a little bit longer chart, this is just a 2-year chart. The yellow line is the 20-day moving average. So if you just take a look at kind of the market as it relates to 20-day, you see that there are numerous dips along the way below that 20-day moving average, and we've had just a very long advance here now above that 20-day moving average. So it just suggests that at some point you're going to get a pullback, some relaxation in particular. And again, if you just kind of look lower, at relative strength, which is kind of the hallmark of just kind of that's kind of the momentum chase. It's just basically the price change of the market. Whenever relative strength gets fairly elevated, you're going to get kind of corrective periods in the markets. And importantly right now, we've got what's called a negative divergence. You have declining relative strength while the market is going up. Negative divergences often are precautionary tales about market, at least short-term market corrections and pullbacks. So again, it's worth paying attention to the fact that you are developing this negative divergence in relative strength. You also have a building negative divergence now in momentum at the same time that the market is moving higher. Again, that doesn't mean markets are going to crash, but it does bring up the risk of at least a short-term correction in the markets, because more often than not, when you have these negative divergences that start to form in the markets, in other words, you have slowing momentum, declining relative strength, but markets are still going up, generally it corrects by not relative strength and momentum improving, it corrects by prices actually starting to come back down and catching up with reality. It's just right now we have a bit of psychological kind of move in the markets that's just really kind of pulling the market higher. Nobody wants to be out. Everybody wants to be in. Nobody wants to sell anything right now. Hey, I get it, because, the market just keeps kind of going up every day. And that's okay. But again, just continue to kind of watch some of these kind of internal measures that are going on in the markets. Again, they just tend to be more precautionary than an outright warning. And again, they can resolve themselves over time. The market can just kind of drift here sideways for a couple of weeks, resolve some of these issues, and then start advancing again. So it doesn't mean necessarily that you're going to have a big correction in the markets. But again, as we kind of been warning about, there's a very decent probability that sometime in August, September, once we get through this month, get through earnings, particularly over the next 2 weeks here, kind of get that under our belt, that sometime in August, September, we get that 3 to 5% correction. Gives you a better opportunity to put some capital to work at that point. So a little bit of patience here will certainly probably pay off over the next couple of months. But that's what you need to know before the bell this morning. When we come back, we'll pick up with Danny Ratliff, talk about why the market's going up, and really nobody knows why. That's today's show on the Real Investment Show. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Will Social Security be there for you when you're ready to retire? Richard Rosso and Jonathan Penn host our next Candid Coffee on Savvy Social Security Planning, Saturday, August 23rd. When should you apply for Social Security, and how much should you expect to receive? Register today for Savvy Social Security Planning, Saturday, August 23rd. Candid Coffee with Rosso and Penn at realinvestmentadvice.com. realinvestmentadvice.com.
This is Lance Roberts with some exciting news. If you've been tuning into us every morning right here on KSEV, starting August the 4th, we'll be exclusively digital on YouTube. So make sure that you like and subscribe our channel at YouTube. It's The Real Investment Show on YouTube, also streaming live on X. Just search The Real Investment Show on YouTube and hit subscribe. Starting August the 4th, we'll be exclusively digital. Get daily market insights, interviews, financial truth, anytime, anywhere. We'll see you there.
The Real Investment Show.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
And now, another page from the Real Investment Advisors Investing Manifesto. Manage risk and volatility rather than trying to manage gains. You don't have to be right all the time. Long-term investing success is a 70% gain. Let us help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors. 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So right now on the news, they're talking about tributes are pouring in from some of the music greats like Elton John and others for Ozzy Osborne, who passed away yesterday. You know who hasn't passed away yet and don't think he never will? Mick Jagger, still there.
Yep. And I don't want to be callous about this.
I think Mick Jagger is going to live to be 300. I think he's going to. I think at some point aliens are going to come down and Mick Jagger is going to meet them, at the landing point.
Well, that guy's found I don't know if it's a fountain of youth, but he's found the
It's called
recipe
drugs.
to keep going.
There's lots of drugs.
Well, but it has the opposite impact on Ozzy, right?
It's probably true. Anyway,
it's kind of amazing he made it that long, to be frank. I mean, it's the situation he was in.
No, trust me. Some of these rock legends, if you know their backstory, it's amazing they live to be as long as they have.
Yeah.
I mean, people say it's like, if you do drugs, they're going to kill you. There's plenty of evidence that may not be true.
Well, these people probably also have the means and ways to maybe hopefully counteract. I don't know. I don't know how that works.
I know. Well, it's like the guy, you tell your kids don't smoke, or you tell somebody, it's like, you shouldn't smoke. Say, my dad lived to 130 and he smoked every day, right? There's always that guy.
Yeah, he was the exception to the rule.
Exactly. Anyway, speaking of exceptions to the rules, Danny's here this morning. Good morning.
Hey, good morning.
How are you?
I'm doing well.
Good. Talking a little bit about the markets this morning. Markets are going up, and nobody really understands why they're going up right now. It's just a tremendous amount of kind of push in the markets. I talked a little bit about kind of some of the speculative things that are going on. We're back to the meme stock chase in 2021. And again, Danny, the thing I can't figure out is where all the money's coming from, right? I mean, it's just you don't have zero interest rates. You don't have the Fed doing $120 billion a month in QE, and the interest rates are substantially higher. Markets are not paying attention to interest rates. They haven't paid attention to interest rates. Everybody's like, oh my gosh, interest rates are going to crash the markets. Well, you've got interest rates running at about 4.3% on the 10-year Treasury right now. markets don't really seem to care. They say if technologies, that if interest rates go up, that impairs CapEx and all that. And we're actually seeing that. Latest report from the regional Fed manufacturing indexes have showed a very sharp drop in CapEx for manufacturing companies. Cost of doing business is certainly higher, so that certainly makes sense. But yet industrials are doing fantastic in the market. So it's just very interesting. There's just, despite the fundamentals.
Yeah.
And, it's just people, and you're kind of, after all these years, people are starting to go, fundamentals, who cares? But despite the fundamental impacts of, higher rates and money flows and all these type of things on stocks, the markets just keep gravitating higher.
I wonder if, and this is one thing that's really difficult to put in context, I wonder how much impact President Trump and him going after Powell and the Fed to lower interest rates has had. And maybe it's the market looking forward, even though, you look at what the FOMC and what the indication is of, how much they're going to cut or if they cut at all. I wonder what the impact is overall on that, because that may be a tad bit of a game changer where actually you kind of talk it into existence. Mm-hmm. And, we look at the numbers and it's not there. But for whatever reason, the market seems to not care whatsoever. So is the market looking so far ahead, even though it's not put in, so to speak, like the odds?
No, at the end of the day, markets respond to, buying and selling activity. That's it.
Yeah,
right?
correct.
And we always want to think that the market is this big forward-looking machine, and there's a bit of forward-looking to it. And, there is a function that forward earnings are really, if you want to get down to the bottom line of everything, forward earnings is the only thing that matters to markets. And forward earnings right now are being ratcheted back up fairly sharply. So all of a sudden, why is that important? The reason that's important is that, let's say I want to buy, a stock, and based on its forward earnings today, that stock trades at a 20 times valuation. So I can say, okay, that's reasonable for a high growth stock. I'll buy it today. And then if the forward earnings then go up to say, they add another $1 or $2 to earnings over the course of the next, year or so, all of a sudden the valuation I'm paying today is no longer 20, it's 18. I go, well, I was willing to pay 20, and now because of earnings going up, I can pay more I can buy that stock here because I can still base this on an idea of 20 forward PE because of where earnings are. So I can move the price higher, and because valuation is simply price times earnings. So if the E increases, and this is why forward earnings are important for markets, then I can increase the value of the P. I can pay more for it. And so right now, estimates by Wall Street are going up. Wall Street's very optimistic over the next few years. And this is kind of the fascinating part, Danny, is that Wall Street is very optimistic about forward earnings. Mm-hmm. But all the economic data, we just saw leading economic indicators come in at a -3 print, a -0.3 print. It's been negative now for about 9 months. So, we've had a very long stretch in negative leading economic indicators. The ISM Manufacturing and Services Index are just flirting around contraction territory. It's not like we have signs of booming economic activity here to support this idea that, forward earnings are going to go taking off to the moon here.
Yeah, no, I agree. But if you look at estimates, even Wall Street has pivoted a handful of times already, right? Mm-hmm. Decent year to start, then all of a sudden you see those numbers deteriorate quickly. Now they're back. I mean, you're seeing estimates from Goldman Sachs at 6,600, right? Another 4.5% up, which I think if many investors, with all the volatility and all of the noise that we've had throughout the year, I don't know if anybody would have expected to say, hey, we're going to extrapolate an 11% return out of this year in the markets.
Yeah.
I would think we'd all sit back and say, wow, this is a fantastic year, all being said.
Yeah.
And many don't feel that way.
Wait, say it again?
Many do not feel that way, right? Because of the big downturn that we had, right?
Yeah, you're right. Okay, sorry, you lost me there for a second. But yeah, no, you're right. You go back to look at April, and we had that near 20% correction. And then a lot of people really haven't realized that we've had a 27% rally following that. It's the sharpest rally since the pandemic rally. And again, this goes back to what I was saying earlier. I get the pandemic rally, right? So in March, we shut down the economy in March, markets down 35%, and then in a matter of about 4 months, we're back to all-time highs. But you had $120 billion a month in QE, zero interest rates. The Fed was bailing out the high-yield junk bond market. You had the government, moratorium. I get that, right? you've had a sharper rally to new all-time highs now, just as you did back in 2020, but you have none of that backdrop. And that's the fascinating part to me. And again, this is just, there's a really interesting article in the Wall Street Journal by, who wrote this? Jacob Spencer, right? Spencer Jacob from the Wall Street Journal. He says, the market rallied early this morning for a reason nobody understands and nobody predicted. Thus began a brilliant but fake Wall Street Journal article courtesy of the Weekly Standard back in 1998. And I think that's interesting because we did see a lot of the same kind of attitude in 1998, 1999. And again, I'm not saying we're about to have a dot-com bust. I'm not saying that at all. But just the speculative behavior and the attitude, and Wall Street was just ratcheting up earnings on dot-com companies, even though most of these companies turned out to be completely fake, right? But it does seem to me that we're completely ignoring realistic fundamentals in terms of how fast a company can actually grow, and we're just making assumptions that companies can grow into their earnings at a much faster pace than what is probably going to turn out to be reality.
Well, the interesting thing is we're trying to put a context on day-to-day market moves and activity on a daily basis, which is a challenge. That's difficult for anybody to do. It's much easier to say, hey, here's what we believe based on these factors, these dynamics, these numbers, what we can extrapolate from the markets over a longer period of time. But the day-to-day activity is primarily, like we were talking about earlier, noise. And essentially, we want to rationalize each and every one of these moves. And sometimes it's just not relevant, number one. And number two, I think, I heard from somebody a while back and they said, I need to know day to day what the market's doing. And we were talking about just kind of big picture stuff.
No, you don't.
And it's like, wait a second.
That's the worst thing you can do.
Well, it is because they said, I need to make good financial decisions. Well, are you a day trader? No. Okay, well, then we probably don't need to be as concerned about the day-to-day one-off activity, but we need to think about how do we look at this longer term? What are the goals? What are we trying to reach? And can we build a portfolio to do exactly that? And so, you're talking about where does money come from? I've always found it interesting in the sense that you hear all these noise, like there's so much money in the largest ever amount of money in money markets right now.
Yeah, that's all corporate money. That's a huge fallacy. Correct.
But at the end of the day, they're going to be net buyers. Well, somebody's selling on the other end.
Right.
There's always going to be, that dynamic. And so that's great. There's a lot of money in money markets, but somebody has to sell for you to buy. The question is at what price? I think is more important than anything.
It's always place. And as we've said before, sellers live higher, buyers live lower. And this is why you've seen corrections in the markets be so much sharper in recent years, is because the buyers are sitting a whole lot lower. So in other words, you're looking at Nvidia trading at say $150 today or whatever the stock price is. I didn't look this morning, but say it's $150 for Nvidia. Well, that's just sellers going, I'm not going to sell for less than this. So what few buyers are there to buy it will pay that price. However, when something comes out, you're seeing this with Texas Instruments this morning is a good example. The buyers are 10% lower in that stock at the open this morning.
Yeah.
And that's why you're seeing these on earnings announcements, those type of things. This is why you're seeing, as of over the last few years in particular, these much bigger intraday moves on stock prices because buyers live substantially lower in price than where they're currently trading. All right, quick break. Be right back.
The Real Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
Will Social Security be there for you when you're ready to retire? Richard Rosso and Jonathan Penn host our next Candid Coffee on Savvy Social Security Planning, Saturday, August 23rd. When should you apply for Social Security? And how much should you expect to receive? Register today for Savvy Social Security Planning, Saturday, August 23rd. Candid Coffee with Rosso and Penn at realinvestmentadvice.com. realinvestmentadvice.com.
This is Lance Roberts with some exciting news. If you've been tuning into us every morning right here on KSEV, TV starting August the 4th will be exclusively digital on YouTube. So make sure that you like and subscribe our channel at YouTube. It's The Real Investment Show on YouTube, also streaming live on X. Just search The Real Investment Show on YouTube and hit subscribe. Starting August the 4th, we'll be exclusively digital. Get daily market insights, interviews, financial truth anytime, anywhere. We'll see you there.
The Real Investment Show.
Are you a financial advisor sneaking peeks at our stuff? Instead of trying to do it all yourself, why not just join the team at RIA Advisors? Our full-service organization can provide you with the support, unparalleled research, and tools for managing your clients' money and honoring the fiduciary pledge of putting clients' best interests first. Don't take our word for it. Talk to the advisors that work with us. Want to come win with us? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors, big enough where it matters, agile enough when it counts.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
If Lance dressed up like Danny, maybe his wife would listen to him. No, that is not the case in my household. I actually had this conversation.
She wouldn't listen to him anyway.
The Real Investment Show podcast.
I had this conversation with my wife yesterday. I told her no on something she wanted to do, and she goes, "I'm sorry, I think I misunderstood what you said."
Same show, your schedule.
You meant, yes, you could do that, right? And I was like, "Yes, honey, that's what I meant." So, yeah, she goes, "I'm going to do what I want to do." I'm like, "Okay."
All right, love you. See you.
Exactly.
At realinvestmentadvice.com.
I could wear a tuxedo, and she is not going to listen to what I have to say.
Real Investment Show podcasts are now available on iTunes. Listen anyplace, anytime at iTunes.com.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors online resources and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So I told you the story, I think, on Monday about my wife ordering the new bed for my son's room because he's going to come home this summer for his break. Mm-hmm. And so yesterday I was up in my office working and I didn't hear anything downstairs. And my wife was working at home, right? And my wife has ADD, bad, right? She cannot sit still for a second, and she'll be in the middle of something, has got to go do something else. So she always has like 4 projects going on at a time in the house. And so I came downstairs and she was upstairs putting the bed together that I had hauled upstairs on Monday. And so she had it all broken down and it was all down in pieces. By the way, why do all these companies send Allen head screws?
Yeah, hex wrench.
Yeah, hex screws. Yeah. Why? Why not Phillips? Why not flathead? I mean, just why? Because they send you that little L. I now have a whole set of.
Oh, I do too.
I've got a whole set of bits.
Yeah.
For Allen wrenches and hex heads, right? And she's up there with that little wrench, trying to put this whole thing together yesterday. Yeah. So anyway, the mattress is downstairs. I had the most fun yesterday. So if you haven't ordered a mattress lately over the internet, it comes in a box. And
it's wild.
It is. It's all massively air
vacuum
compressed.
packed.
It is, and it's all in a roll. So this thing probably weighed, probably 150. I had to go to the gym this week because hauling all this crap upstairs for my wife. Has been a workout. So anyway, I grabbed this thing, throw it on my shoulder, take it upstairs, and then you get to cut the thing open, and it goes. It was the most fun I've had in like 3 weeks. Just watching that mattress go flying across the room. It was awesome.
Easily amused.
Oh, I am. Clearly. I am. My dogs were like, out of here.
So you got this because.
So I
came
told
home for the summer.
No. So I was telling the story on Monday my son has had, so all my other kids, this is how much I love my son, my pride and joy. All my other kids have new beds, right? They've gotten new beds over here. He's been using the same bed since he was 6.
Okay.
So
Out of the crib into this one.
yeah, this is like a trundle bed and single, just a twin mattress, and he's been on this thing since he was like 6 years old.
I mean, that's
Yeah,
about right.
I was like, if you want a bed, go buy it yourself. Anyway, so
But you bought it for him right before he's leaving to go back to school.
No. He's in summer school,
Yeah.
and he's going to come home on the 5th. My wife's aunt is getting married, so we've got this big wedding coming up on August the 5th. So he's coming home for that, and he's going to be home for 2 weeks. And so my wife was like, "Okay, I got to get him a bed." So he's got a new bed. He'll be happy. But it was so much fun. Just you know what? Just order a mattress just so you can open it and then send it back for whatever reason. But
You should have shot a video of that.
oh, I'm telling you, I missed it. I didn't think about it, but I should have done it because it was a ball. Anyway,
Your
So are you gonna
TikTok channel would go wild.
yeah.
So that
it's-
2 weeks he's going to be with you, you're going to bill him? I mean,
Oh no, so look, this is what you don't know this yet because you still have kids at home. Your kids are still young, but we've now become an official Airbnb, which is our kids come home and they get free breakfast, and they have their room, and then they get maid service because my wife goes up and makes the beds after
well,
they
this
leave.
is not an
and cleans
Airbnb.
up.
This is a bed and breakfast.
Bed and breakfast. Sorry,
yeah,
it's a bed and breakfast. So I am.
Chateau Roberts.
Yeah, I am literally I'm working on this now, but I'm going to get room numbers and put on the rooms. So when they come over, it's like, yes, you're in room 1. Here's your key.
Bathrooms down the hall.
No, they have bathrooms that like the main suite up there has its own bathroom.
Really?
So yeah, all the kids fight over that one. So anyway,
Chateau Roberts.
I know. I'm telling you, the kids
You got to dust
got
off
it
the
made.
tux and,
Exactly. Just stand there when they come
Warm
in, hand them
towels when
champagne.
they walk in,
Exactly. So I'm
That's
just
great.
they're going to start getting charged though. That's what's coming.
I knew that was going to come at some point.
Oh yeah.
Or at least you were going to say you're going to charge it.
Yeah.
Yeah, good luck
I don't know
collecting.
I don't know if my wife will actually go along with that one.
I'm
but-
sure when they come in town, you check the bank account, you're like, oh my gosh.
Oh,
what just
trust
happened
me.
here?
No, that is absolutely a true statement. My daughter, my oldest daughter, came home last weekend.
Yeah.
Yeah, nails, hair, shopping. My wife. The good part is my wife was gone all weekend. I had all weekend to do whatever I wanted.
Yeah.
But I paid for that time. So
Paid
High
dearly, I'm
maintenance.
sure. Yeah.
Exactly.
Funny, Michelle's very, she doesn't like spending money at all, but her and my daughter can go do something. And it's like, oh, she needed this. We need to go get this for her. And I'm like,
Oh, that's. I tell you what, my wife and the girls, that's expensive.
yeah.
When my sons come home, not so much, but yeah,
They don't
for the
need as
girls,
much.
Exactly. Anyway, all right, let's get back to work here. So we're just talking about this market's been rallying, and there's really, and really, you talk to most people, they'll come up with, kind of the reasoning, right? And we've talked about this before. Back in 1998, it was the decline of the Bangladesh dollar. It was a completely fake news story, but the point is that market moves from one day to the next generally don't have much to do with anything other than speculative activity. And, like today, the market's up because of a trade deal with Japan. We don't even know for sure if that deal's been done. It's just been an announcement at this point.
It's not been finalized, what I read this morning.
Yeah, it has not been finalized. And, and I've told you the story before about in early 2000, the market was up sharply one morning because IBM announced 5,000 layoffs. And then it was down in the afternoon because IBM had announced 5,000 layoffs. It can't be both. Right, but we're always trying to assign a narrative to the market for whatever the market's doing that day, and generally headlines have nothing to do. So, but that's how markets and media work. Media needs to justify, and investors, kind of like looking at a Rorschach chart, Rorschach chart. Yeah, it's a big blot on the thing. You've got to make figure out what it looks like. That's how we have to react to markets as individuals. We're always trying to figure out why the markets are doing this, why the markets are doing that. Sometimes it's just doing what it is because it's doing what it is. And importantly, we need to be able to navigate that. And Danny was making a really good point just before the break that one of the worst things you can do to your portfolio is watch the market every single day. I've told you before, like when I'm managing money for the portfolio, when I'm at home during the day and the market's live, I don't have anything on. I turn all the media off. I turn, financial websites off. I don't look at the market until the end of the day and then do my work from there. Because what happens intraday is generally meaningless for the markets. And that actually leads us to making much worse mistakes because of all the emotional traps that we fall into by watching every tick of the market all day long. Now, if you're day trading, it's a different thing, right? So, I mean, if I'm day trading a position, yeah, I'm going to watch the market during the day, right? Because I'm just going to look for an entry point, look for an exit. I'm going to day trade. But if you're investing, the best thing you can do for yourself is turn all that stuff off and go focus on your job and let the markets do what they're going to do over time.
Well, I think that's exactly right. Now, don't think that we don't have people watching the portfolio on a regular basis, because we do. But
not every second.
But what
of every
that
day.
Means is essentially, and that may be a good idea to step back and say, okay, what does that look like if we have trailing stops, things of that nature, that we're not putting a hard stop, but we have technology that says, hey guys, take a look at this. Something's going on, right? But then you can put your eyes on it, say, all right, is this news related? Is it sector? Is it specific to the company? What is actually going on with this position? But you nailed it when you said, hey, if you could look at it, if you're not looking at it intraday all day, every day, you're going to really probably take out a ton of that emotion that's assigned to, anybody has that, right? Even as a professional portfolio manager, as long as you've been doing this, you still see something and, it's probably easy to be inclined to want to do something you shouldn't do, which is why we have to stick to a discipline.
Right, yeah. Yeah, sometimes the best thing to do is do nothing.
Yeah.
Especially when you feel like you need to do something, it's often best to do nothing at all. And then just try to figure it out, make a rational decision. Because again, generally if you're feeling stressed to do something, that's generally your emotions working against you. And again, the hardest thing to do as an investor is to not follow your emotions and to stick to your discipline. And that's a very challenging thing to do.
Yeah.
But
no, it is. And so, I started to think about all the different dynamics from this year. Obviously a very volatile year. We've talked about how we're likely going to trade more frequently than others. And that's been the case because of the volatility that we've seen. But, going back and kind of racking my brains, like I've heard everything from, I can't find any reason for the market to go up from here. And this would be in, April when the market's down at its worst.
Right.
Market's going to continue to go down. We're going to get into, a recession / depression. And if you go and look and just search and scour what was going on online or in the media during that time frame, there were pretty compelling arguments in a lot of ways from people that would say, hey, here's what's going on. Here's what you guys need to be doing. And unfortunately, it leads to a lot of bad decision making. So I've also heard that the market can't go up anymore from where we are today, right?
Right.
Just yesterday.
Yep.
Why is the market going up? We want to assign that rational to it. And, we talk about this, and I tell clients often when we visit, we can create a pros and cons list at any given time. And almost every single time, that cons list is longer than the pros list.
Oh, yeah.
But the market knows about everything that we can all think about. So what keeps us up at night is, what does the market not know? What's out there that's looming that, nobody quite sees yet? And so the interesting part, or the difficult part about managing money in this environment, is probably managing emotions. We need a degree in, psychology and investor behavior, probably just as much or more than markets.
Yeah. Well, and again, this goes back to, building portfolios, building structures, managing risk. We talked about that. And again, when you start, talking to individuals and like, oh, I have to watch this market every day. I've got to be on it every second because I need to make the right financial decision. You're going to wind up making the worst possible decisions doing that. And yes, there's volatility in the markets. You're going to have short-term corrections, but reacting to every little move in the market as if it is the beginning of the next event. This is the problem with all these really bearish media headlines. The market's going to crash 50% because of this or whatever it is. Those are typically the worst things you can pay attention to when managing your portfolio. Just, again, we have to focus. At the end of the day, fundamentals matter. The thing that matters is forward earnings. And as we've talked about before, the one thing that you need to understand with every event headline is just simply go, how does that impact forward earnings? And if it doesn't matter to your portfolio. All right, be right back after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
Will Social Security be there for you when you're ready to retire? Richard Rosso and Jonathan Penn host our next Candid Coffee on Savvy Social Security Planning, Saturday, August 23rd. When should you apply for Social Security? And how much should you expect to receive? Register today for Savvy Social Security Planning, Saturday, August 23rd. Candid Coffee with Rosso and Penn at realinvestmentadvice.com. Realinvestmentadvice.com.
RIA Advisors Research is the envy of the industry. Our economic insights are featured on advisorperspectives.com, Fox Business, and MarketWatch. RIA provides advisors with marketing and back office support, objective research, and holistic, cutting-edge financial planning tools to meet your clients' needs. Want to join a winning team and be part of a fiduciary culture where you can do your best work? Then why haven't you contacted us yet? Go to our confidential advisor hub at realinvestmentadvice.com. RIA Advisors. Big enough where it matters, agile enough when it counts.
The Real Investment Show.
This is Lance Roberts with some exciting news. If you've been tuning into us every morning right here on KSEV, starting August the 4th, we'll be exclusively digital on YouTube. So make sure that you like and subscribe our channel at YouTube. It's The Real Investment Show on YouTube, also streaming live on X. Just search The Real Investment Show on YouTube and hit subscribe. Starting August the 4th, we'll be exclusively digital. Get daily market insights, interviews, financial truth, anytime, anywhere. We'll see you there.
And now, another page from the Real Investment Advisors Investing Manifesto. A passive investment portfolio requires active risk management. It's not a choice, it's necessity. Diversification doesn't protect against risk of loss. Let us actively help you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So just interesting comments. We were just talking about, as I was concluding that last segment, I said, look, the thing that matters is, and the only thing that matters to your portfolio is whether or not it affects forward earnings. And so when you hear about, us bombing nuclear sites in Iran, how's that going to impact forward earnings for NVIDIA, right? If it doesn't impact forward earnings, you can disregard it. It's not going to impact markets for very long. And comments in the chat were, well, yeah, but in 1999, there was no event. Yes, there was. And there was an analyst meeting in early 2000, and an analyst questioned Enron's accounting. And when Kinley answered that question, it opened up everybody to start looking at how Enron was accounting. And then that spread across the entire .com sector. And all of a sudden, all of the theses about how these .com companies were manufacturing earnings, et cetera, all came into question. And then from there, from Enron, came WorldCom, Lucent, Global Crossing, and one bankruptcy after another, because all of the fraud, and Enron was an outright fraud, but there was also a lot of very fraudulent estimates built into company reports.
Well, mark to market changing.
Well, that wasn't until 2008.
Yeah, that's right.
That's 2008. Then we'll get to that one in a second. But after that occurred, we then passed Sarbanes-Oxley Act. And again, always in hindsight, right? We pass an act to fix the previous problem. But the reason that we passed the Sarbanes-Oxley Act was to make sure the executives of companies were tied, and the CFO had to sign off on an earnings report under perjury that report was true and accurate, so there was liability. And so all of that fraudulent stuff came out. And so, and why is that important? Because all of a sudden, forward earnings collapsed. All of the expectations for forward earnings completely fell apart for these companies because, again, they were just made up for the most part. Danny's right. In 2007, 2008, you had the subprime crisis going on, and you had Bear Stearns, but those weren't the big catalysts, right? Because it was Bear Stearns, okay, great, it's a little mortgage event, no big deal. Their high yield return fund blew up. It's fine. It's a one-off. Markets were correcting. But what caused the big collapse in 2008, 40% of the entire correction occurred within a matter of about a month, when Lehman was forced into bankruptcy, because all of a sudden counterparty risk was realized that was no longer available and nobody would trade with each other. And all of a sudden the credit market came under dramatic impact. And when that happened, that also affected forward earnings outlook. Of course, also the recession at that point. Forward earnings estimates dropped sharply. That impacted the markets. So when you look back through history, whether it was 1974 black bear market with the collapse of the Nifty 50, whether it was 2008, whether it was 1999, the big corrections, the ones that matter. Now, 1987, 20% correction, portfolio insurance blew up. Okay. Short-term lived event, right? You can have these little 20% corrections. Those are part and parcel of just normal market volatility. But the ones that everybody worries about is like, oh my gosh, this is going to cause a 50% correction in the markets. It always relates back to either credit or forward earnings expectations. One of those two things. So whatever the event is going to be, when somebody tells you the market's going to crash by 50%, okay, why? And does that why relate to either credit or does it relate to forward earnings expectations? And if it doesn't, it's not a valid reason.
It's probably more news.
Yeah, probably more news headlines.
Yeah.
Yep.
So right now markets are sitting at in a good spot, right? We do have kind of a critical point at some point here from a resistance perspective, but there's not much overhead. So, expectations, forward earning estimates are all looking better. What are you looking at right now compared to, what kind of the noise is in the narratives? Because you mentioned, the basics, right? Mm-hmm. Price to earnings, forward guidance. Mm-hmm. What else are you looking at right now?
Well, in terms of just the market in general?
Yeah.
Just technicals. Yeah. At the moment, the technicals are just very extended, very overbought. I talked about this morning in the morning update that we have negative divergences and relative strength and momentum. And that just suggests that we're just kind of, running out of buying power, so to speak. You're getting fewer buyers into the markets. Markets are having more trouble rising higher. So this morning, again, you've got some really, some news driving the market. So, this trade deal with Japan, it's got automakers on fire this morning. They're going to do good on that, particularly after GM's report yesterday. They need it. But the question is great. We open up, 20, 30 points on the S&P, but if we only end up the day up 5 or 10 points, that's just more that indication that we're, having a harder time driving markets higher. If, what we need to see is this market go up, stay up all day, and they even finish stronger into the end of the day, and then start to see that relative strength improve, start to see momentum improve. But so that's really kind of the thing I'm paying attention to right now. Is just whether or not we start seeing improvement in the underlying fundamentals. And breadth is not great in the markets. It's about average. But you would think that with how markets have been performing, particularly the last 3 months, that we'd have very broad breadth in the market, and we really don't.
Yeah, that's been interesting to watch. Market breadth, what did we have a couple of weeks ago? We had one of the better days, but you let one of the worst days for market breadth. And then we've had one of the best days for market breadth just this week, but actually not a very good day or not a great day, right? Kind of just ho-hum.
Yeah. So again, outside of just, the fun, and the thing with fundamentals is those take a long time to play out. So just managing portfolio risk near term is all about the technicals. And so we're just watching the technicals and paying attention to that for kind of just near term risk management.
Yeah. I know you like to look at CAPE-5, cyclically adjusted price to earnings, but that's been elevated for years. To some extent.
It has. But so you have to back up and you have to explain that real quick, which is, you're talking about Schiller's CAPE-10 ratio, which is the average of 10 years of earnings. And Dr. Robert Schiller, Yale University, he created this PE ratio using 10-year average earnings to smooth changes in earnings reports. So, for instance, you had a big drop in earnings in 2008 because of the kind of the collapse of the market. Big drop in earnings in 2000 because of the dot-com crash. So he takes 10 years of that. So he kind of smooths out those big bumps and just gives you a kind of a smoother valuation metric. If you cut that in half and use a 5-year average, and so I developed this CAPE-5 ratio that we use internally, it is more aligned with the markets. And in terms of market dynamics, it has a better relationship to that. But again, it's a 5-year average. So it's a terrible market timing device.
Yeah.
Right? And again, to your point, it's been elevated for quite some time. It is very elevated. Valuations are very high right now. That doesn't mean markets are going to crash. It does mean at some point that we're going to have a mean reversion in valuations, but that could either be through prices stagnant and earnings increasing, or price declining and earnings coming down as well. So generally it's the latter that occurs. But again, it's a terrible market timing device, but it is something that we do pay attention to, and it is concerning the level of valuations that investors are paying for assets. We are clearly overpaying for assets, so there's no argument with that. But that doesn't mean markets are going to crash tomorrow. It just means that the risk reward of asset ownership is becoming much more stretched right now.
I think we've been able to make that argument. I think that's actually been a deterrent for many people to stay on the sideline until they see it continue to go up. And they're like,
the problem, you can be
well, I got to get back in, right?
You can be there for 20 years waiting on, a mean reversion event. And that's happened. Honestly, it's the last time we had a mean reverting event and valuations was 2008.
Yeah.
So, if you were waiting for valuations to get back into a better place to where I could buy cheap, you've been out of the market for, 17 years now.
Well, you've had some opportunities, but most people probably didn't take advantage of them.
Well, no, but I'm just saying
that's what you were waiting for.
Right. This is one of the things about John Hussman, right? So John Hussman runs the Hussman Fund. Brilliant guy. Absolutely brilliant. But he's a big fundamental guy. And so, he talks a lot about valuations and future returns of markets based on valuations. And so if you look at his analytics, he's absolutely correct. But you would have been out of the market waiting for that mean reversion of valuations for 15 years, right?
Yeah.
And so you've missed 15 years of returns by waiting for this mean reverting event that hasn't occurred. It doesn't mean that it won't, right? But they can be very long in between. We had a mean reversion in valuations in 1974. You didn't have your next mean reversion in valuations until 2000, right? Then you had another mean reversion in 2008, and you haven't had one since. So there can be very big gaps in time between mean reverting events and valuations. The point is though, at some point you do not want to ride through a mean reverting event, which is why it's important to manage risk in your portfolio. Because you don't know when or what's going to cause it.
Well, and if you're waiting forever to try to get back into the market, and then you don't have that exit strategy, because that's the problem I think we saw. Leading up to 2020, we were getting calls on a daily basis on, hey, how do we get back in? I've been out since 2008. And the problem was, even when we had the larger dip in 2020 because of COVID, they weren't getting back in.
Yep.
And that's the issue, is that everybody wants to buy low, but nobody wants to physically buy when it's time.
Because it's hard.
Yeah, no, it is. Absolutely.
Because when prices decline, what's our first instinct? I don't want to buy it here. It's going to keep going lower.
Oh, you want to run.
And then when markets are high, we want to buy it because markets are going to go higher. So again,
Which is so counterintuitive.
Right. We do exactly the opposite of what we should do. We buy high and we sell low. But there's some great points in the chat right now talking about value pickers are dead. Absolutely. Value has been a terrible investment for 15 years. Will value eventually have its day? Probably. What's going to cause it? Don't know. But this is why our portfolio has some value in it, in good quality companies. They are making money, but then we also have the growth side of the portfolio as well, which is participating in the markets. And this is why it's important to understand market dynamics, look for rotations, those type of things. And again, if you go to SimpleVisor, we have entire analysis based on market sector, factor rotation, those type of things, all at simplevisor.com to help you manage and navigate those better. All right, have a great day. Be sure and like and subscribe to the channel because, again, we're going all digital on August the 5th, so we want to make sure and keep up with you. Like and subscribe right here on our YouTube, The Real Investment Show. See you back here tomorrow with Michael Leibowitz.